So we go to impacts of errors in classification of expenditure. So if expenditure is wrongly classified in the account, it will have an effect on both statement of profit or loss and other comprehensive income and the statement of financial position. So if we wrongly classify expenditures, either capital expenditure or revenue expenditure, that means it's going to affect both the statement of financial position and the statement of profit or loss.
Materiality.
Materiality.
We cannot make no mistakes. We have to be.
Yeah, items must go in line with where items must go to where they are supposed to go to. So, if any expenditure is wrongly posted, if it was supposed to be capital expenditure, you record it in revenue expenditure, it will affect the statement of profit or loss, and it's going to affect the statement of financial position. Mm-hmm. So, for capital expenditure, if capital expenditure is treated as revenue, profit will be understated as expenses will be wrongly increased. Listen, for capital expenditure, which is expenses on spending on long-term assets, right, or non-current assets, if you mistakenly record it or you treat it as a revenue, a revenue expenditure, it will reduce your profit. Your profit will be understated. Why? Because capital expenditure is always large. It's high amount of money, you know. So you mistakenly recorded it in your statement of profit or loss. That would increase your revenue. It will increase your expenses.
So what will increase your loss?
That means no, it's not going to increase your loss. It will reduce your profit.
Yeah, reduce profit.
Get the point here. If capital expenditure like the purchase of motor vehicle is being recorded as revenue expenditure, like maybe motor vehicle expenses, so it means your expenditure will be higher, and that would reduce your profit. Is it clear? So that means it's going to affect your statement of profit or loss. Your profit will be understated. Is it clear? If revenue expenditure is classified as capital expenditure, then profit will be understated as expenses will be lower, while the statement of financial position will be overstated because the value of non-current assets will be what? Increased wrongly or incorrectly. So what we are saying is if revenue expenditure, which is supposed to be in your statement of profit or loss, is being recorded as a capital expenditure, your profit will be overstated. You have more profit because it is your revenue expenditure is not part of your items anymore. You have motor vehicle expenses or motor vehicle maintenance, which is supposed to be recorded in your expenses, in your statement of profit or loss, but you mistakenly recorded it in your statement of financial position as an asset. It means that your expenditure would reduce, and if your expenditure reduces, it means your profit will be overstated. Okay. But what happens to your asset? Your asset will also be what? No. Will increase, will be overstated. Both profit and asset will be overstated. That is the consequence of recording revenue expenditure in capital expenditure. It increases your asset and at the same time increases your profit. Okay. And both of them are incorrect. Okay. Is it clear? Is it clear, please? Yeah. So that takes us to activity 3. For activity 3, we have different items. So here it says that first made in computer sales, computer hardware and software. During the year, it has invested in a new inventory control system. The following transactions have been recorded as capital expenditure and revenue expenditure. We have items such as new computer for resale, new inventory control system, installation cost of new system, staff training for new system, maintenance of inventory control system, computer supplies for new system. So here we have the figures. Mm-hmm. For 160, 160, 40, 2,000, and capital expenditure we have 10,000, 7,000, 450, 500. So we have to, the items are not correct, so we have to put them in the correct position, either as in the statement of profit or loss or the statement of financial position. So I'm going to start with the first one. They said new computers for resale. New computer for resale is purchase. It's purchase.
So it is a revenue expenditure.
It's revenue expenditure, yes.
That's correct.
It's correct. The new inventory control system. New inventory control system is a purchase, but it's a new system. Yeah, so it is capital expenditure, which is going to go to your statement of financial position.
So you're going to make another ledger and put
another table, not ledger, table.
And put the 40,000.
So the item, you're going to have your items, then you have capital expenditure, revenue expenditure. Under your capital expenditure, you're going to have your statement of financial position. Under your revenue expenditure, you're going to have your statement of profit or loss and other comprehensive income. Right. So our purchase here is the purchase of new inventory system and new computers for resale. So for the resale, it's going to be revenue expenditure, which is correctly done. But for the new inventory system which is capital expenditure, which is 40,000. Installation
A capital.
is capital expenditure. Then training cost. It's not going to be for every time, so it's revenue expenditure. Maintenance cost is going to be revenue expenditure. Then computer supplies is also revenue and computer supplies, revenue expenditure. So the total capital expenditure here is 50,000. That's 40,000, which is purchase of new inventory and installation. And the rest goes to your statement of profit or loss and other comprehensive income. Then we go to capital income and revenue income. Are you there?
Yeah.
For capital income, this for revenue income I wrote is a result of the benefits or the receipt of operating activities in the business. So all items that involves the day-to-day running of the business, which you receive, is called revenue income. Examples are revenue from sales of inventory. Your stock, when you sell them, it's a revenue income. Rent received, maybe you give part of your office to a tenant.
Yeah.
You receive income from that. It's part of revenue income. Commission received, for maybe you sold an asset. You receive a commission from selling a property.
Yeah.
It's a revenue income. Interest received. You gave a loan out, or you gave, maybe you saved money, you received interest from it, or your credit customers, they paid late, then you charge them interest. These are revenue income.
Okay.
Then discount allowed. Why is this? Is discount allowed? You gave discount to your customers, but why is it part of revenue income? It's part of revenue income because you have given discount based on the fact that sales is coming in.
Okay.
Do you understand?
Yes.
It's going to be on the debit side too here.
Okay.
Then we have capital income. For capital income, we're talking about receipts of money which is generated through non-current assets.
Okay.
Like-
the money generated to non-current assets.
Yes, like your
Within a
capital,
year.
the amount of money the owner of the business introduced into the business, or you take a loan from the bank.
Perfect.
So these are what we call capital income. Any question about that?
Sure.
So that ends the chapter. So